Welcome to the financial analysis video, and remember that this video is just for academic purposes. I am Kata Mishek with my colleagues Cosmas Chirwa, Amnad Msaka, Rebecca Banda, Josephat Hara. We are from the University of Zambia studying business administration, and we are excited to share with you our in-depth analysis of Zambia sugar consolidated accounts as part of excellent consulting group. In this video, we'll be plunging numbers and uncovering trend using time series comparison from 2021 to 2023. We will dive into the world of financial ratios and common size analysis, and our findings are clear and precise, direct to the point. So before we go in the analysis, let me just do a quick background of Zambia Sugar. So Zambia Sugar is in the agricultural sector, is in the agricultural sector, and its main core purpose is just to produce sugar. And there are three primary operations of Zambian Sugar. Number one, it is production. Number two, it is in the crop management. Number three, just distribution. And Zambia Sugar is playing a very vital role in the Zambian economy. It is contributing very greatly to the Zambian GDP, and it is providing employment. And the other important things about Zambia Sugar is that it follows the international accounting standard rather than the US GAAP. So for now, let's dive into the analysis.
We are going to go straight into the ratios, and the first ratios that we're going to analyze is profitability ratios. And we are going to look at gross profit margin. So gross profit margin, these are profits that are made after the deduction of cost of goods sold. So in 2021, we can see that gross profit is standing at 51%. In 2022, it is at 43%. In 2023, it is at 43%. So we can see just a steady decrease in terms of gross profit. So from there, we are going to move to the next ratio, which is operating profit margin. So these are the profits after the deduction of operating expenses. So as we can see that in 2021, operating profit was standing at 32%. In 2022, we can see that it is standing at 24%, and in 2023, it is standing at 21%. So we can see also a steady increase, or a gradual decrease rather, in terms of operating profit. So from there, we can also look at net profit margin. So we can see the same trend from gross profit, operating profit, and even in net profit margin, there is a gradual decrease in terms of profits for this company. So in 2021, we are seeing 22 net profit margin. In 2022, we are seeing 20% in terms of profit, and in 2023, we are seeing 16%. So we can see that the profit is decreasing by the year, and this could be an indicator to the investor that it is not good for them to invest into such a company. So we are going to go straight into liquidity ratios. So liquidity ratios helps us to know and assess the ability of the company to settle short-term obligations. And the first ratio we're going to look at is current ratio. So current ratio helps us to know if the current assets are able to settle current liabilities. So we can see here that in 2021, Zambia Sugar is able to cover short-term obligations in 2021. We can also see that it has always been, from 2021 to 2023, it is able to settle short-term obligation, which is a good thing for the company. So this is an indicator for the investor that it is safe in terms of the company to settle short-term obligations. So from there, we are going to go straight into quick ratio, or it could also be called acid test ratio. So we can see that in 2021, Zambia Sugar is able to cover short-term obligations using quick ratio. And in 2022, we are seeing that it is not able for it to settle short-term obligations because it is at 0.68. So meaning for every $1 or quarter they owe, they have 0.68 to pay, which is not safe for the company. So from there, we're going to go straight into cash ratio. We want to see if the current cash that the organization is having is able to solve or to sort out short-term obligations. So we can see that clearly that in terms of cash, the company it is not able to settle short-term obligations. 0.31 in 2021, 0.14 in 2022, and 0.72 in 2023. So from there we can see that for every dollar or kwacha that Zambia Sugar owes, it only has 0.31 to pay in 2021. And in 2022, we can see that for every $1 that it owes, it only has 0.14 to pay. So from there, now we are going to move straight into efficiency ratios. So efficiency ratios, it shows us how efficient the organization is for it to be able to convert its inventory into sales. So we are going to start with credit payable period. So this shows us how many days that the company is giving to settle its debt. So from 2021, we can see that it is given 90 days for it to settle short-term obligations. And in 2022, we are seeing that it is given 89 days for it to settle short-term obligations. And in 2023, we are seeing that it is given 76 days. It is reducing by the day, or by the year, sorry. It is reducing by the year, which may not be a very good sign, looking at how many days that they give their debtors to be able to pay them. So if we are to compare here debt collection period and also credit payable period in 2023, we are seeing that they give their debtors 35 days to pay them, whereas they are given 76 days for them to pay, which is a very good sign. They are able to get their monies and invest before it is been 76 days. Yeah, and also in 2022, we are seeing that they are given 50 days for them to be able to collect the monies from the debtors, and for them to pay their creditors, they are given 89 days, which is a very good sign for the organization. So they are given 89 days before they can even pay their creditors. Yeah, so we move straight to inventory turnover period. So this shows us how many days it takes for the organization to convert its inventory into cash or into sales. So we can see that in 2021, it has 155 days for it to be able to convert its inventory into cash. And in 2022, it is having 158 days. We can see an increase, which may not be a very good sign for them, because if their creditors are to come and ask for their money, they may not be able to pay. And in 2023, we are seeing a very massive decrease in terms of days for them to convert their inventory into cash, which is a very good sign for the organization. Yeah, so we can also talk about the cash conversion cycle, which helps us to look at how many days it takes for the company to convert its inventory into cash, and also the number of days it takes for them to collect monies from their debtors, and the number of days they are given by their creditors to pay. So we can see that in 2021, they had 102 days, and in 2022, 119 days. In 2023, they are having 106 days. So from there, now we are going to move straight into solvency ratio. So solvency ratio talks about the ability of the company to be able to settle long-term obligations. So the first ratio that we're going to look at is debt to equity ratio. So as we can see here from the diagram, that in 2021, the debt to equity ratio is standing at 0.78, which clearly shows that it is a good sign the company is able to settle its long-term obligations. So for every 0.78 kwacha they owe, 0.7 ngwe. For every 0.7 ngwe they owe, they have 1 kwacha to pay. For every 0.7 ngwe they owe, they have 1 kwacha to pay. And we can see that the debt to equity ratio is decreasing by the year from 2021 to 2023, which is a very good sign. So the investor is more than happy or more than willing to invest into this company, because we are not seeing anything that would distract them from continuing into doing business. Yeah, so from there now we're going to move to interest coverage. So interest coverage, it is only helping us to know the ability of the company to generate enough profit for it to cover interest expense. So we can see that in 2021, the company is standing at 6. And in 2022, we are seeing that the company is standing at 15, and in 2023, the company is standing at 31. So we can see that Zambia Sugar is able to generate enough operating profit for it to be able to cover interest expense. Yeah. So then from there now we are going to look at the free cash flow to firm. So free cash flow to firm, yeah, it is a measure of the cash that is available to all the investors of the company, both equity holders and also debt holders. So we can see that in 2021, Zambia Sugar had 1,528,006, and in 2022, Zambia Sugar is having 1,329,349, and in 2023 it is standing at 507,917. We can see that the cash that is available to all the investors in the organization is decreasing by the year, which is not a very good sign to the investor. Which is not a very good sign to the investor. So this is the ratio analysis of Zambia Sugar.
So now I'm going to analyze this statement using the other tool of analyzing financial statement, which is the common size. Yeah. So I'm going to start by analyzing the statement of profit and loss. Yeah. So we can see that the statement that we were given from 2021 to 2023, the cost of sales was increasing from 48.6 in 2021 to 56.8 in 2022, and a slight decrease to 56.3 in 2023. So we can see that the impact of gross profit, the impact of cost of sales caused the gross profit margin also to decrease from 51.4% in 2021 to 43.2% in 2022, and slightly increase to 43.7% in 2023. So the implication here is that higher cost of sales might be due to increased production costs, such as the increase in labor cost, the increase in transportation of raw material, or the rising in raw material price in the market. Yeah. So the increase in cost of sales will also make these other element of statement of income, statement of profit and loss also to increase. We can see also that the operating profit decreased from 32.4% in 2021 to 21.4% in 2023. So the implication here, the implication of the decrease in the operating profit is going to be due to the reduction in the operation efficiency, which increased the relative to revenues. Yeah. Then the other thing that I'm going to talk about here is the other element we can talk about here is the increase in the administration expense. So the increase in the administration expense can be maybe the management salary and wages has increased. Yes, so this can also contribute in the decline of the profit. So we can see that the profit for the year from 2021 to 2023 decreases. In 2021 it was 21.8%, and in 2022 it was 19.7%, and in 2023 it was 16.1%. So the implication here tells us to say implication in the increase of cost of sales will affect the profit for the year, which is not good for the investor and for the business.
We now look at the cash flow analysis, and we are calculating each item of the cash flow statement as a percentage of revenue. So, and we're also looking at the trends in terms of operating activities, investment activities, and also financing activities. So what we're more interested in when it comes to operating activities, we are looking at the inflows and outflows of cash that affect the net income. So here we can see that the company has been generating positive cash flows in terms of operations, but it has been fluctuating where it has gone up, down, and up. When it comes to investing activities, we can see that the company is able to invest in plant and equipment, but it still fluctuates from 10% up until to 18% of the company. And we can also see that the company is still able to issue debt, is still able to issue equity, and it pays dividends and also covers, it also pays dividend.
Okay.
So I'll be talking about earnings quality and red flags. So earnings quality refers to the sustainability and reliability of company earnings. For a red flag, we're just talking about indicators of potential issues with earnings quality. So I'll be talking about the use of accrual. So the use of accrual, like the aggressive use of accruals in the company, that is not a good indicator. Like to an investor, even for our business, it is not a good thing, no. Because the accrual concept just states that we recognize a transaction when it just incurred rather than when cash changes hands. Yes. So when the company is in a consistent, like it is consistent in the use of accruals, like when it is selling its goods and services, just dealing with the accrual principle, that is not a good indication to an investor and the business. Again, I'll be talking about the discrepancies between the net income and operating cash flow. So when there is a very large distinction between net income and the cash from the operating operations, that is not a good thing again, no. It is a red flag, because we know that the profit in the income statement, it is an accounting profit. And that profit, I can say, it is not like the company is having at that time, no. It is just the profit that has been recorded. It is just the profit that is just on the paper. It is just in the account. Maybe some other money is there with the debtors. Yeah, so when there is that very, very large distinction, the net income and the cash flow from the operation, that is not a good indicator to the company and an investor. So if there is that consistency, you find that in this year there is a very big deal. For example, let's just talk about in 2021, there is a very big difference of net income and the cash flow from the operations. That is not a good indication. That is a red flag. Yeah. So when I was checking the differences between the net income and the cash flow from the operation for Zambia and sugar, it is just a good thing. Yeah, it is just a good thing. There is no such a red flag, yeah, in Zambia and sugar. No. Yes. So apart from that, again, let us just try to look at the differences between the International Accounting Standard and the US GAAP. So there are just few differences. So when we talk about the International Financial Reporting Standard, it is just a single standard for revenue recognition, focusing on the transfer of control. But when we talk about for USA GAAP, it is similar to the International Financial Reporting Standard with a focus on the transfer of control, but within some differences in the application guidance. Again, there are some differences on impairment. For International Financial Reporting Standard, impairment and losses are recognized when carrying amount exceeds the recoverable amount, and reversals are allowed. But when we talk about the US GAAP, impairments and losses are recognized when the carrying amount exceeds the undiscounted cash flow, and reversals are not allowed. Yes. In conclusion, our advice to an investor who is intending to invest $1.5 million into Zambia sugar is that wait until we see the profit margin begins to increase, because as we saw earlier, we have seen that the profit margin have been decreasing from 2021 to 2023. For more information, check in the description below.